Vodafone tax case, the 22,000 crore battle that shook India's legal system. A mysterious foreign deal, $11 billion acquisition and a 22,000 crore tax notice that turned the Indian legal system upside down. It started with a handshake in the Cayman Islands and ended in the Supreme Court of India, international arbitration and a parliament rewriting the history. This is the Vodafone tax case and it is not just about money. It is about trust, law and power. The deal that triggered a storm. In 2007, Vodafone Netherlands acquired CGP Investments, a Cayman Island firm, from Hutchison for $11.1 billion. CGP owned a controlling stake in Hutchison SR, a major Indian telecom player. But here is the twist. The deal was made entirely offshore. No shares of the Indian company changed hands. So no Indian tax, right? No, you are wrong. The Indian Income Tax Department said, you acquired an Indian asset through an indirect deal and we want our cut. 11,000 crore to be exact, plus interest and penalty, totals to 22,000 crores. Vodafone refused. They said this is a foreign transaction. India cannot tax us here. The Supreme Court showdown began. The case went all the way to the Supreme Court. At the heart of it was one question. Can India tax an offshore deal if the underlying asset is Indian? Key legal points. Section 9(1). Income deemed to accrue in India if it arises from a capital asset in India. The tax department argued, look through the structure. What Vodafone bought was control over an Indian company. Vodafone said, we bought shares in a foreign entity, CGP. There is no Indian asset transfer. Was it tax evasion or legal tax planning? The court dissected every detail. Then came the verdict that shook the system. In January 2012, the Supreme Court ruled in favor of Vodafone. The judgment highlights, Section 9 did not apply to indirect transfer before the law was amended. The transaction was not a sham, it was valid tax planning, not evasion. Vodafone was not liable to deduct tax under Section 195, has no income accrued in India. The court emphasized certainty in tax law, saying taxpayers must know in advance what is taxable. The tax notice was quashed. The court ordered a refund of 2,500 crore. Vodafone had won, or so it seemed. The government's counter-strike. Barely months after the Supreme Court ruling, the Indian government did the unthinkable. In Budget 2012, a retrospective amendment was passed, backdating tax laws to 1962. This gave India the power to tax past indirect transfer like Vodafone's deal. In simple terms, the law changed after the court ruled, and it was made to apply to transactions that were already closed. Global investors called it tax terrorism. Confidence in India's legal system took a hit. The start of the international battle. Vodafone did not back down. They took India to international arbitration at Hague under the India-Netherlands Bilateral Investment Treaty. In 2020, the tribunal ruled in Vodafone's favor again, saying India had violated international law. The final resolution. Finally, in 2021, India withdrew the retrospective tax law, ending a saga that lasted over a decade. Vodafone was offered a refund if it dropped its claims. The case had exposed the dangers of unpredictable taxation. The Vodafone case was not just about tax, it was a battle between law and power, between certainty and control. It taught us changing law is easy, but rebuilding trust takes years. Do you think India was right to defend its revenue? Or should the court's ruling have been final? Let me know in the comments. Hit subscribe for more real stories from India's legal battlefield. This is Pocket Tax Lawyer decoding law for your life.